Hey everybody, it's Chris Buteau with Cleveland Street Mortgage, and today I want to talk about protecting your purchase money second mortgage, preserving the character of that mortgage for future use when you go to refinance that, roll that first mortgage into, that second mortgage into a new first mortgage, and eliminate, some of the less attractive features of second mortgages. Tend to have higher interest rates. Tend to be variable interest rate, or if they're a fixed interest rate, tend to have a higher interest rate. And sometimes are a great way to go about purchasing a property. You need to combine a first and a second. It just optimizes the overall cost of your money going in. But if you have the opportunity later on down the road to refinance that and roll that together, whether or not you tapped into that second mortgage again after you used it as purchase money can have a dramatic impact on the cost of refinancing. And here's why that can be. Generally this only is going to apply to a home equity or revolving line of credit. A home equity line of credit, they call them, or HELOCs. If you use those to buy a second, and the reason for that is, of course, it's a revolving line. And so it's designed to be tapped into and paid down and tapped into and paid down. And if you use it to buy a property and you have some excess capacity on it, and let's say 6 months in or 8 months in, you need to make a draw for a short-term use of funds, and let's say you take $10K out of that, then you've just characterized any subsequent repayment of that mortgage with a new first mortgage as cash out. It no longer is characterized as what they call a rate and term refinance. And the reason that matters, and it matters a lot, is because rate and term refinances are less costly. They're priced far better than a cash out refinance, and underwriting tends to be a little more generous as well. You'll be more likely to get an appraisal waiver. Underwriting conditions are generally less restrictive on a rate and term refinance than when you're taking cash out. And so be careful of that. I did have a client who had a very short-term need and tapped into it just at the recommendation of the home equity line of credit provider, who at the time probably wasn't anticipating that he'd be refinancing or what the impact would be. But it changed the cost of refinancing by about $13,000, just because of a very short-term need and a very relatively modest loan amount. So be careful about that. If you can, leave that purchase money home equity line of credit alone. Don't touch it. Don't take anything out of it. Just pay it down, according to schedule, and you'll have much better options going forward. Thanks so much.